The three SG banks, DBS, UOB and OCBC share price just keeps going up. One of the reasons is partially due to their final year dividend that will be paid soon. However, even though interest rate might come down, these three banks might still be able to do well. So in this video, we'll go through what are the risks and pros when it comes to investing in the current Singapore banks. For those who are new here, I'm Ben, who likes to share financial contents and analyzing on different companies. You can also give comments on what you would like me to work on next. So let's get right into the video. Even though banks' share prices has risen from the past 2 years, banks are still at the expected yield of more than 6%, whereas some of the REITs are priced at 5 to 6%. Honestly, it's hard to buy REITs with potential yields lower than banks due to the difference in their long-term dividend growth. Of course, this is not encouraging you to sell all your REITs and just investing in banks. Diversification is very important, and investing in the good REITs will give you good returns as well. There are a lot of negative perception that with the interest rate most probably getting cut this year, banks will not do well. That's why it's important to hear the bank's management's perspective and how they are preparing for the interest rate cuts. One of the main differences between dividend companies and REITs is that dividend companies do not have to give 90% of their income as dividend. This gives them a lot of flexibility to grow the company and to grow the dividend at a faster rate as well. Just comparing banks' historical dividend alone versus other REITs, banks stand out. Even if you stretch out to look pre-COVID over the 10-year periods, banks still give a much higher increase in their dividends, with only 4 REITs doing better than the rest. If you include the bonus dividends from the respective banks, DBS stand out with the 3-year growth rate at 31.1%, while the 10-year growth rate is at 14.8%. Second comes in with OCBC at 15.7% and UOB at 12.3% for their respective 3-year growth. Parkway Life REIT is one of the rare ones where their 3-year dividend growth has increased by 1.6%, while their 10-year is increased by 2.5%. If we filter the 10-year dividend growth, the 3 banks is still on top, followed by Keppel DC REIT at 4.1%, CapitaLand India Trust at 3.2%, Mapletree Industrial Trust 2.6%, Parkway Life REIT 2.5%, and Maple Logistics at 1.9% growth. However, when it comes to income or dividend investing, it does not mean that these REITs are to be ignored. Buying any companies at the right price would give you a very attractive starting yield. The dividend growth throughout the years will be a plus point. Of course, past performances do not dictate future performances. Based on the current environment, I'm still in favor of banks as dividend, which I'll explain why later. For those who are new to bank earnings, it's typically split into interest income and non-interest income. It's very important to differentiate between the two. Interest income is the interest earned from loans, essentially mostly from the debts. Non-interest incomes are incomes essentially from other stuff such as credit card fees, insurance commissions, and other random charges. If the bank has insurance income involved, they are also categorized under the non-interest income. So based on the table for the 3 banks, DBS is the largest with income at 20.18 billion. DBS also has the lowest interest income percentage at 68%, whereas OCBC has the highest at 71.4%. Based on this table alone, if the interest rate comes down, OCBC should be the one that is impacted the most, as their interest income is at the higher end of 71.4%. However, this is just only one minor factor. I feel that in the long term, these 3 banks will still do well. Next, if we look at their growth rate, interest income growth for DBS and OCBC is higher than UOB at 25%. However, if you see the non-interest income growth, UOB came in at an astronomical amount of 85%, which allowed them to propel their total income to be above OCBC. DBS also had a decent growth at 18%. Later in this video, we'll look into why is it the case that DBS and UOB are able to have this higher non-interest income growth. If you like my video so far, please support the channel by hitting the like, subscribe, and comment on what you feel with regards to investing in banks. If you are interested in the analysis of the balance sheet, my previous video had a quick analysis on their results. Thank you, and let's continue with the video. UOB Bank has been very aggressive when it comes to expanding. They have targeted to double their private wealth assets by 2026. This can be seen from the purchasing of the Citibank's consumer businesses in Malaysia, Indonesia, Thailand, and Vietnam. This is very exciting because by purchasing another consumer business, this expands their customers and will definitely improve their non-interest income for the next few quarters, which can be seen on the reason why their non-interest income year-over-year growth is at 85%. They have also seen huge inflows from Hong Kong, China, and other countries as they see Singapore as the safe hub. Ultra-rich personnel in Malaysia, Indonesia, and Vietnam are expected to increase in the next few years. This will definitely benefit UOB Bank that is actively expanding in these countries. Another factor that is impacting the banks in a good way is the concerts that are happening in Singapore. Honestly, I did not expect the concerts to have such a huge impact to the credit card spending. If you see just Taylor Swift's concerts alone, consumer has spent over 30 million on tickets in Q1. Q1 overall spending for the cards have increased by 10% year over year for UOB. Hotels, transportation and travel registered a 30% year-over-year growth. During the week of Taylor Swift concert, card spend in Singapore rose by 35% compared to the previous week. Spending at clothing retails leaped by 85% week over week. Transportation and travel grew by 80%. Amusement and entertainment grew by 50% while hotels grew by 45%. Spending at clothing outlets in the town area increased by 130%. This might be an exceptional case for the Taylor Swift concerts, but it definitely proves a case that having a lot of concerts definitely help in the economy. As more spending occurs in Singapore, this would definitely help all banks in general. UOB also previously had a 5 billion acquisition from the Citi Consumer Group back in January of 2022. This was expected to double the amount of customer base outside of Singapore in ASEAN countries. With the integration of Malaysia and Indonesia completed, positive results can be seen from their balance sheet, with credit card fees increasing by 66% year over year. The integration of the Thailand business will be done by Q2, while Vietnam will be in the upcoming months. I'm hopeful that with this integration, UOB would definitely be able to expand into these markets more quickly. In their 2024 outlook, low single-digit loan growth is expected, while there's a double-digit in the fee growth. Total income is expected to see positive growth, which is very impressive considering that the interest rate is coming down. Of course, higher income will be good news for shareholders because higher income would translate to higher dividends. Now, how about DBS? For DBS, in my opinion, they are more aggressive when it comes to rewarding shareholders. That's why sometimes their final dividend with the special dividends involved have a very high payout ratio. But this does not stop them from growing as the Singapore's biggest bank and have a lot of capital to spare. So for DBS, their current focus on growing is on China and India business. DBS has also bought Citibank's consumer business in Taiwan. This resulted in consumer banking customers to double to 1.1 million, while the credit card accounts increased by 5 times to 3 million. Similar to UOB's situation, this has helped to propel DBS to expand greatly into Taiwan. This is very exciting, and hopefully we will see exciting growth results in the next few quarters. In the Indian market, DBS has finally managed to fully integrate last year the bank that they have purchased back in 2021. Currently, DBS is very aggressive when it comes to expanding in India. Even though the cost to income ratio in the Indian business is still in the highs of 70%, they are hopeful that as they scale up the business, the cost to income ratio will naturally come down. Just to give you a context on how expensive it is, usually good businesses have the cost to income ratio to be about 40%. Next, the exciting part is that DBS has also bragged about having so much capital that they will be able to maintain a 0.24 cents annual dividend increment even with the post-bonus share base. Just to share that for every 1,000 shares that you have, the dividends will increase by $240. If what the management said is true, this would mean a 11% increase in the dividends for the following year. Moreover, they have also said that they could do some special dividends or other forms of capital returns. That's why reading earnings call is very important, because this is where you can get different insights that you can't get from financial reports. Lastly, because of digital transformation, it is able to provide a higher ROE to DBS. They are expected to have a 17% in ROE for 2024 and 15% in the long term. This is very impressive because normally banks will only be able to achieve a ROE of 12% to 14%. So being at 17% or 15% is above average. This is one of the reasons why DBS has been constantly priced at a premium as compared to UOB and OCBC. Next, let us look at OCBC. OCBC Bank is a well-known bank that is usually more conservative as compared to UOB and DBS. OCBC also has a lot of capital. However, when analysts ask with regards to the capitals, they are looking on a more conservative approach where they will keep some as buffer and looking for organic growth opportunities rather than giving back to shareholders. Examples of organic growth are such as investing in talents or investing in new technologies. Moreover, back in 2023, they have also mentioned that they are expected to add 3 billion in revenue from the ASEAN and Greater China strategy. So we'll just have to closely monitor on their growth prospect. One concern that their analysts had was with regards to their commercial real estate loans. OCBC has the largest amount of CRE loans at 12% of the group loans. On the bright side, a lot of loans is in Singapore, which, to be honest, I consider it quite stable. Loans in other countries such as China, Hong Kong, UK, and US are considered to be more risky. One interesting thing is that they have mentioned that for US CRE, they are actually on the more riskier side. Therefore, they have stopped all loans for them. So this is quite alarming if you are a US office REIT shareholders, because this is what might be one of the reasons why they could not get the loans. Next, they have mentioned that with the improvement in technology, hopefully they could get more customers and therefore more deposits. Next, one of the reasons why OCBC had a temporary drop in their share price was due to the drop in non-interest income in Q4. You can see they had a small dip in the non-interest income, mostly due to the drop in the income from insurance. So when an analyst asked with regards to the income, Great Eastern CEO mentioned to look on the full year basis, and this is a one-time off drop, which is quite true because GE consistently has been producing good results. So in the long term, I am not a big concern of it. Lastly, OCBC management has also mentioned that they are also committed to giving dividends, but at a sustainable payout ratio. So there are good and bad pointers for shareholders because this meant that there will be lower growth in the dividends, but at the same time there will be more cash for the banks for growth. In conclusion, throughout the years, the banks have been doing very well consistently, even through the COVID and great financial crisis period. So in my opinion, these are the positive sides for the banks. Firstly, is paying out ratio at around 50% range. This meant that they will keep 50% for growth. Next, rates cut might be slower than expected due to better economy from AI advancement. Third, like all banks said, companies will usually take out more loans when interest rates are being cut. This will help to balance out the drop in the net interest margin. Fourth, due to global uncertainty, companies are coming to Singapore as a safe hub. This will also benefit local banks as well. Lastly, the increase in spending due to the active number of concerts happening in Singapore and the CPF withdrawal potential in 2025 can be a positive side for the banks. Of course, everything comes with a negative or potential risk. For banks, the biggest risk is that if interest rate drops more than expected or the growth in the consumer loans do not grow as much as what the banks expects, then the bank's earnings might have a drop this year. The second risk is that if the global economy goes into recession, then banks would definitely suffer as well. Third, if the Hong Kong and China market continues to weaken, some banks would definitely be affected, especially OCBC Bank. So I hope this provides a good insight into what is the situation with the 3 SG local banks. I hope you enjoyed this video. Please support the channel by hitting the like, subscribe, and comment on what you would like me to talk about next. You can also watch my previous video where I talk about the results of the banks and choosing the best REIT to invest on. Thank you, and I'll see you in the next video.